Hello everyone, welcome back to Case Studies with the Biz Doc. This week, it's the Dropbox IPO, the long-awaited Dropbox IPO. I'm going to talk about the market for file sharing and collaboration software. Number one, key competitor Box, which is already public, so we can see into that company and look at some things. And then I'm going to take you through the history of Dropbox and what I believe the IPO value is going to be. So let's start with the market. Over here, this is called the Gartner Magic Quadrant. If you look up Gartner online, many of you do, you can see how they evaluate companies in a given sector and then make a little graph of those companies as part of their very elaborate analysis. People look at that because it's a quick visual indicator of what Gartner thinks. You get bragging rights on it, and also consumers make decisions about it, specifically those enterprise business consumers spending billions of dollars on IT. And those are billions of dollars that Box and Dropbox want. You go over here, and there was two axes. Completeness of vision. So how much of a vision you have, how complete it is. From here to here, bigger vision that's more finished. From here to here, the ability to execute. So you may have a big vision, but can you pull it off? Can you do it? So, and if you've got the ability to execute, but kind of a weak vision, they call you a challenger. If you have the ability to execute and a full vision, they call you a leader. And if you don't have much of a vision and not much of a ability to execute, then you're a niche player. And if you got a whole lot of vision and not a lot of ability to execute, they just call you visionary because you just have vision. You need to get some guys and execute. If you look up here, big company, you've got Google and Microsoft, two giants with file sharing solutions of their own. You have Google Docs and all that goes with it, and Microsoft OneDrive. It's just amazing stuff. And Dropbox right here and Box right here. So Gartner sees Box as a little bit ahead in terms of the completeness of the vision, probably on the enterprise side, because Box is more about enterprise initially, and Dropbox was more about consumers initially. Although both of them are running to those business markets right now because that's where the money is. So we're looking at two big players. We're not looking at startups anymore. We're looking at players that are now up playing with the big boys and winning every day. And don't count out those two guys as you move forward. Now let's go take a look at Box, because I want to cover them because they're public, and then we're going to jump into Dropbox. Let me step out of the way over here so we can take a better look at this. Box right now has 44 million registered users. Now those may be people that are not paying a dime. They're just using, say, a freemium service. But they have 80 to 90,000 enterprise clients. And Box has been highly focused on security, features, functionality, and winning enterprise clients. That's been their high focus. Box was actually the one that was founded first, 2005. Dropbox 2007, and we'll get to them in a minute as I roll into the IPO analysis. They were up in Mercer Island, Washington, and they moved to Redwood City. They, in 05-06, getting the company going, and the first big money was $1.5 million from Draper Fisher Jurvetson, DFJ. And within 2 years, another 6. So that first $7.5 million, the key player there was a very big VC that understood the enterprise space, and that is DFJ, specifically Tim Draper. Overall, they would go on to raise $560 million in 11 rounds, and there's an inflection point along the way. As they grew this with that, they took another $15 million 3 years later from scale, bringing their total to 24. Then in 2012, it picked up. They raised 48 and then 81 in 12. In 13, they raised $125 million from General Atlantic. And then in 2014, boom, they raised $250 million and had sales of $216 million. At that point, the board and everybody said, time to go public. We have got a product, we're closing in on $250 million of sales, and some of these VCs want to use the IPO to get a return on their investment because that's the natural order of things. They were adding features and functionality very, very effectively, and then they jump out with the IPO. During the IPO year, they went from $216 to $302 million, so they were up 40% in revenue that year, and they went out at $14 a share, which I think, if my memory serves me correctly, was about a $1.7 billion valuation on the IPO. But that day, This thing went out like a rocket and settled at about 23, so 14 to 23. Now you might say, gosh, was that IPO a little underpriced? The company got 14, but it was soon at 23 in the market? Well, not so fast. Let's take a look at what happened. Over that year, they would drift all the way back down below the IPO price to 9 or 10, and I think the lowest point of a given day was actually 6. But as you can see, they lost over half of their first day value at 23, even though they drove the company from $300 to almost $400 million, $398 million in 16. So they grew another 32%. So they grew 40% and then 32%. So maybe the market wasn't like a big fan of the growth rate slowing. Then the growth rate slowed again, down to 27%, but they got up to $500 million in sales. That's meaningful. But look what happened. I call this a tale of two cities. The first year after the IPO, the stock went down. Then the next 2 years, they have been driving up. And since the IPO, they have done 11 consecutive I can't even speak today. 11 consecutive quarters of quarter-to-quarter revenue growth. And they've also, over the course of the last year, announced that 3 out of 4 quarters, they were cash flow positive as opposed to posting losses. So in other words, a grown-up company that's doing a really good job in the market. And right now, they're worth $3.1 billion in market cap, give or take, on what today's close is, at $23 a share. And we are sitting here January of 2018, exactly 3 years from the IPO. Now let's take a look at something else. You look into that and you say, wow, this came down, this came up. What did Aaron Levie and his management team do? Well, he had some comments about that, some thoughts that I think are very important and they're very telling. So here's what Aaron said. He said, first, being public has actually helped us, and there's 3 reasons I think it's helped us. The first is it helps us compete with Microsoft and IBM. Well, wait a minute. Look at here. Big boys. Why is that? He said, because we're on the stock market and we're perceived as being a large, significant company, and people can look up our performance and see that we are a large, significant company, closing in on $500 million of sales in 2017. Also, he says, the quarterly reporting brought discipline to my team. It forced me and the team to think about everything we did because we have to report it to the stock market. I think that's a very mature point that he made, because you could look at it this way. I can't get my strategic plans done because every 13 weeks I got to go report to the doggone market. Or you can say, you know what, my strategic plans are made better because we have to think about how the market's going to respond to them and always think about giving a return for the shareholder. That's the position that Aaron Levie was taking. And he said, third, a publicly traded company also helps us with long-term incentives when we give people stock options. They can open up the newspaper. Listen to that, open up the newspaper.
Back in my day.
They can go to any site they want to see the stock price and understand where their options are. And he says they look at their employees now and say, look, you can see the price, we want to drive it up, we hope these options are a long-term incentive for you. So he feels that it helps him compete with the big boys by being on the market. Quarterly reports bring discipline, and a publicly traded company brings morale up because everybody can see where the stock is going and what's happening for the options that they've been giving. I think that that's a pretty strong example of leadership coming from Box. So we can see Box, the enterprise player that's got about 90,000 users in the enterprise space, and it's got a big list of very large enterprise clients that have selected their solution, and that's what they lead with. They lead with the big right hand of enterprise functionality. Now, let's compare to Dropbox, and then I'm going to take you through what I think that IPO value is going to be. Okay, so now let's look up at the top of this very complicated board today, which I hope is helpful in its complexity. We go to Dropbox, founded in 2007 in San Francisco, and actually came out of Y Combinator, one of the most successful companies to come out of the incubator. I did a case study on that. You can go back and take a look at what Y Combinator is all about and the benefit that accelerators and incubators provide to startups. So here we go. They get out, and coming out of the Y Combinator as a very positive graduate, they got about $6 million from Sequoia. What was very interesting, it also shows you the power of early blogging. A article that was on Digg, D-I-G-G, they had about 5,000 people that had signed up for a beta.
Tom's word of the day.
And a beta is a test that's going to be closed, so it's only a certain amount of people, invitation only. Send them an email with a link. They can come in and use the product, but you're not open to the public through a common link on an external website. Well, after an article on Dig, they went from 5,000 to 75,000 requests that they filled to be in the beta in '08, and they scored $6 million from Sequoia. And they got off and running pretty quick, and there was a lot of buzz in Silicon Valley. So much so that a gentleman named Steve Jobs asked Drew Houston, the founder, along with Arash Ferdowsi, and they asked him, hey, come over to Apple, I want to talk to you about something. So in 2009, they're in Steve Jobs' office talking about it, and there was a couple things he wanted in there. There's some technology bits Apple was interested, and then he went on to say, well, this is more of a feature than a product. I mean, as legend has it, this is how the conversation went. And why don't we just buy you? And to which Drew said, no, I think I'm going to go long and I want to drive this. We successfully get out of Y Combinator. We got Sequoia backing us, and you know what? I don't think we want to get bought. And he said, well, then iCloud is going to kick your butt.
Round one.
Well, guess what? Not only did iCloud not kick its butt, iCloud didn't kick anybody's butt, and I can't think of people that I know that use iCloud. And then iCloud got the celebrity hack, where all those celebrities that had the pictures on their iPhones that were automatically synchronizing to iCloud, and then they had this incredible hack, and all of a sudden we saw more pictures of Jennifer Lawrence than we really wanted to see. Well, some people wanted to see them, I didn't, but all those celebrities got exposed and iCloud got embarrassed. Well, guess what? That was basically it. What do you hear from iCloud now? It's on your iPhone. It kind of forces you to use it, but not a product anybody's, I think, really thrilled with. And so on they went. Smart decision. A year later, they celebrated 1 million users. A year later, they had gotten to 50 million users. These are registered users now on the freemium product. You get this for free and a certain amount of storage with these features, and hopefully you buy up to need more storage, especially if you're, a video person or a person that's got a lot of pictures, a ton of them that you're storing up there. Suddenly the space needs, and you go from freemium to paid, and that's a natural progression that they're always trying to convert. So Index comes along, invests $250 million, and that is on the path. We're about to see what happens here, where they would raise $2.1 billion over 7 total rounds. So they raised 4 times the money that, right at 4 times the money that Box did. So then, 2012, they double to 100 million users. In 2013, they double again to 200 million users. And remember, there's a lot of rumors going on about, is Box going to have an IPO? And Box was doing good with business. And interesting to see how they shadowed each other. Boom, they announced Dropbox for Business. And they also announced something called Mailbox. They made some acquisitions. What was interesting here, I really liked the way Drew Houston did some of these acquisitions. Some people say, oh, they bought things and then they died, and then they bought something else and they didn't take care of it and it died. Well, wait a minute. I happen to think he was being pretty smart. And I think, as we're about to see through here, one of the tenets of 0 to 1 is get there fast and test. And don't lose your mind defending what you're testing. If it's going to die, bury it quick and go test something else. Get yourself into a fast iteration cycle of introduce a feature, test the feature. If the market likes it, great. If they don't like it and it's dying, bury it and get on to the next one. But don't get your pride and ego out there. I got to make it work. I got to make it work. So on one hand, people look at that and you admire that. On the other hand, it's easy to be an armchair quarterback and say, oh, look, they tried this and it died. They tried that and it died. Really? Well, there may have been people outside Thomas Edison's lab saying that too, but if he hadn't kept trying, we don't have the light bulb. So I happen to think this is a good, fast, iterative process that comes right out of Peter Thiel's book, 0 to 1. So then in 2014, this is when their alarms started ringing and everything went nuts. Remember in 2011, all the money that was being raised by Box? Well, 3 years later, they raised in January $350 million from BlackRock. In April, $400 million from JP Morgan, a name that would stick with them. And then in November, $350 million at a $10 billion valuation, led in heavy participation from a gentleman named Luigi Gilardi. and a significant investor on the independent side. And so the total thing, they raised $1.2 billion in 2014. 1 year. There's only one word for that, and that is damn. That is a lot of money in the venture world to be raising in 1 year. And none of it was debt. This is all equity financing. Then 2015, that 200 million registered users become 400. And there was also something very interesting happening. They were very carefully strengthening their board. They brought on in 2014 the ex-CEO of Priceline, Bob Mylod, if I'm pronouncing that right, from Priceline, and they brought in Condoleezza Rice. And Condoleezza Rice had a little bit of controversy because people were saying Dropbox because they felt that coming from a conservative side, she wasn't supporting human rights at a certain level, which really, I'm not sure how true that was, but it all blew over, and they had the strength of Condoleezza Rice, who was, at one point Stanford provost, incredibly intelligent woman, powerful board member, and now the CEO of Priceline. They would actually add to the board, adding Paul Jacobs of Qualcomm in 2016 and Meg Whitman, who had run for governor of California and had driven eBay all the way up, Meg Whitman. So now they got people that have driven public companies from the technology sector, a very, very strong board. So people could sense, hey, they're getting ready to go public at some point. And so the waiting game began. When is Dropbox going public? From 15 to 16, the 400 million registered users became 500 million registered users, and they also announced that they had crossed 50,000 enterprise users. Very important now that now they were seen as being the consumer product with tons of registered users, a lot of freemium, but not a lot of conversions to paid. And now they're out there saying, no, wait a minute, let me show you something. We're making it work. We understand that this can't be like Twitter and be free forever. There's got to be a revenue model in here that makes sense and scales forward. Well, then in 15, they had bought Mailbox in 13, adding a mail service product. And then in 15, that wasn't working. They canceled Mailbox, and they also canceled something called Carousel. And then in 16, they also announced that they had built their own data centers and were no longer reliant on Amazon. That was a strategic move. They thought, I don't want to be reliant on Amazon. I want to build my own data centers and my own storage facilities so that all of my clients are dependent on me, and I'm not dependent on Amazon. Not that Amazon's going anywhere, but those are strategic things. You don't want to necessarily be completely in bed with somebody like Amazon with their muscle, because as we've all seen, they are ruthless competitors and they will do whatever they want to a market space. Go back and look at my Toys R Us case study, and you'll see how Toys R Us partnered with Amazon, and then Amazon absolutely gutted them. And so I think whether that was on Drew Houston's mind or not is a lesson here, and many people thought it was a strong, strategic, positive move to move away from the Amazon stack. Well, they also announced 16 going into 17 then that they had hit 200,000 enterprise clients, along with those 500 million registered users. Well, along comes also in 17, they raised another $600 million. This time they raised debt. Debt told me that they were going out for an IPO. Here's why. They had more than enough statistics that they could have raised more venture funding. Heck, a week ago, Uber just raised another $1.2 billion in funding with the new CEO in place. So you can always, I think, if you're successful in the business growing, go back to the equity stack. Well, they went to the debt stack. What debt does is it doesn't dilute all of your previous investors. Debt is an opportunity, if you can serve it, to get money, and if you have the ability to pay it back, it doesn't cost you anything on the ownership side. So I think that's what they were doing, and they were thinking about the IPO, and I'll tell you why in a second. At that point, they also announced some results. They said, we are on a $1 billion revenue run rate, and it's EBITDA positive, and we're growing that revenue at about 30% a year. Wow, let's think about that a second. I think the list there, I think there's fewer than 3,000 companies that have $1 billion in sales. I think it's closer to 2,500. which means that they have built a proven company. They've added to the enterprise stack. They're obviously getting freemium conversions because they got $1 billion in sales coming from somewhere, which is twice the $500 million the same year that Box has just announced, 2017. Actually, they haven't announced, they gave guidance to it. We'll know in a month or so when Box makes its official announcement. But don't bet against it being $505 million. So here you have it, and then they announce we are doing a confidential IPO filing. Well, under the rules to go public, you can file confidentially, but it leaks out and everybody knows about it, but you don't have an S1 published for public inspection. What an S1 is at sec.gov, you can go, if you hear a company's going public, and you can read the S1. There's a lot of incredible, helpful information in there about the market, about the company, about their past sales, how much stock the insiders have, the marketing strategy, and all their expectations, very carefully and with great sanitization presented for public inspection ahead of going public. So looking forward to be able to see something like that, but it's Goldman and JP Morgan that are going to take them out public. So Goldman joins JP Morgan, who gave the debt and had 400 in equity. So JP Morgan's got $1 billion in this deal, and JP Morgan's going to go do the IPO along with Goldman. So that's interesting. So where do we think it's going to be? Well, if we step back for a second and remember that right now, Box at roughly $505 million, 3 out of 4 quarters cash flow positive, $3.1 billion market cap, and we're hearing that Dropbox going to have twice that, $1 billion EBITDA positive for 2017. So where does Dropbox's valuation come out? Well, let me take you to the Biz Doc algebra. What I've done here is put together a little analysis of where I think the first day market cap is going to be, and I'll tell you why. Right now, in the market, cloud-based services of whatever form, big ones, little ones, successful ones, growing ones, flat ones, it's about a multiple of 4.7, give or take, on revenue. Meaning if their revenue was $100 million, times 4.7, as long as they're profitable, you would expect that company to be worth somewhere around $470 million plus or minus. Down from that, if they're not very profitable and they've got growth issues, maybe up from that a little bit if they have strong profits and strong growth. But that's sort of the barometer of where it would be. So if you take that, and Dropbox has announced that for full year 17, they had right now $1 billion in run rate. If you figure another 4 to 6 months on getting ready for the IPO, and if they're growing 30% a year, I cut that down instead of 30% to 1.3 billion. I just held it at 1.2 billion. So a little conservative. I multiply this 4.7 times 1.2, and on a revenue multiple basis, I get $6 billion of valuation market cap. Well, that's interesting. That kind of gets you to the same place. $1 billion being twice $505 million on revenue. Market thinks that Box is worth 3.16. Now let's apply a little market enthusiasm and IPO enthusiasm. So I took, say, a 20% premium on the multiple, the 5.6, and this becomes 6.8. So all of a sudden you get putting together what we call goalposts, just like football, a low end and a high end of where you reasonably expect it to be. And I put a little lift on this, and I got to about 7 billion, because I think there's going to be a lot of enthusiasm and a lot of hunger for a tech IPO. And what I mean by that is last year, some tech IPOs like Snapchat didn't go particularly well. So I think there's a lot of market interest and hunger for a tech IPO, and a lot of very interested investors because the market's doing well and they want to invest money on some things maybe a little more speculative and get a better return in exchange for that risk. So I think if you take this up a little bit, I think that first day market cap is going to be about 7 billion. Now, we haven't seen an S1 or any facts, and this is what I want to be seeing to feel good about my kind of 6 to 7. You can see the flow that I'm building here and the goalposts coming together. I want to see that freemium conversion has been continuing at a good pace? And where exactly is the mix of consumers versus enterprise that's getting you that $1 billion in trailing 12-month run rate that you're telling us, Drew? I also want to know that the enterprise percent is going up, and any statistics in there that I can go back and look at quarterly earnings report for Box. Now you're going to have head-to-head competition, and you'll look for key stats where they compete against each other. And I'm also want to see a focus on security and enterprise features. Clearly, they've been fearless about buying plug-in companies, tuck-in acquisitions to add things, and equally fearless about, you know what, that's not working. Let me get back to my strategic focus, which I think is very, very good. So that's what I want to see when the S1 or pre-market materials are visible. And then I want to continue to see elements that we can compare Dropbox and Box together as we compare them and see how they continue to do against the hyper-capitalized market players, Google and Microsoft, who are all represented in the leaders square of the Gartner Magic Quadrant. So that's the Dropbox IPO. There's a lot of interesting things. Here's 3 quick lessons I've got from it. I think Drew Houston, I think he tried quick, let it die quick, and get on to the next thing. I think they've done that very well. I think they've reacted to bring Dropbox business into place. And I think they've got great people around them. Meg Whitman, Paul Jacobs, Condoleezza Rice. This is a group of people that are going to give credibility to your board and confidence to the market that you've got adults in the room helping you as you go public. So get great people around you. That's a lesson for you and me as you make your board of advisors, and you don't have to wait till you're going public after 10 successful years of building a storage and collaboration product. You can get great advisors involved with you early on, and I recommend it. Thank you for watching, and remember, Valuetainment is on a drive to 1 million subscribers, and please help us get there, because when we do, we will announce the first annual Valuetainment Entrepreneurs Conference. We're going to put so much content and so much value into that, it's going to make you say, damn, that was a great conference, and that helped my business and my life and my leadership. Until next time, I am Tom Ellsworth, the Biz Doc, and I hope I left you better than I found you.